This is Mark to Market, a podcast of BT correspondents.
Hello, everybody. Welcome to Mark to Market, a BT Correspondence podcast that aims to provide analysis and insight on market trends and corporate issues in Singapore. My name is benpaul, and I'm a senior correspondent at the Business Times. Every week, my colleagues and I delve into a business story that matters. We're in the month of August 2025, and the national effort to revitalize the local stock market seems to have kicked into a higher gear. On the 1st of July, the Monetary Authority of Singapore announced the appointment of the first 3 fund managers under its $5 billion Equities Market Development Programme, or EQDP. The 3 fund managers are Avanda Investment Management, Fullerton Fund Management, and JP Morgan Asset Management. MAS said it will place a combined initial sum of $1.1 billion with these 3 firms. The next phase of the fund manager selection under the EQDP is expected to be announced by the 4th quarter of 2025. Besides naming the first 3 fund managers under the EQDP, MAS also said last month that it has set aside $50 million to enhance its Grant for Equity Market Singapore scheme, or the GEM scheme. Now, this is a scheme that's been around since 2019, and its purpose is essentially to expand the number of listings in Singapore and the amount of equities research on local companies through subsidies. Among other things, the latest $50 million allocation to the GEM scheme will provide funding support for research on private companies with a strong Singapore presence. The idea here is to stoke investor interest in these companies and build a pipeline of potential listings. Meanwhile, listing grants under the GEM scheme will be expanded to cover Singapore depository receipts and foreign depository receipts with underlying Singapore stocks. The overall funding for primary listed ETFs will also be increased, while a new funding sleeve will subsidize cross-listed and feeder ETFs. In addition to this expansion of the GEM scheme, MAS also outlined plans last month to better enable investors to seek recourse if they suffer losses due to market misconduct. Now, I'll come back to this particular set of proposals later in this podcast. Let me first talk about the EQDP and the impact that's having on the local market. I think it's fair to say that the EQDP is the most important initiative in the whole effort to revitalize the Singapore market. It is the one proposal put forward by the MAS Equities Market Review Group that investors have been most excited about. The fund management firms that participate in the EQDP are expected to pursue investment strategies that go beyond the big index component stocks, and this should, logically, improve liquidity and broaden investor participation in the smaller cap segment of the market. In fact, over the past couple of weeks, there has been strong interest in a whole bunch of non-Straits Times index stocks that analysts expect will be pursued by fund management firms that receive EQDP funds. For instance, Maybank came up with a list of what it called potential EQDP beneficiaries, which included stocks such as AEM, ComfortDelGro, Food Empire, iFast, Nanofilm Technologies, and Sheng Siong. UOB Kay Hian also had Food Empire and Sheng Siong on its EQDP buy list, along with other stocks such as Valuetronics, Propnex, Marco Polo Marine, and recently listed Lam Chung Creations. Given this very positive reaction from analysts and investors, it seems to me that the EQDP could be a potent driver of the Singapore market in the months ahead. In fact, if the funds under EQDP are made available to small investors, I might invest some of my own money in them. Now, I'm fully aware that some folks simply don't agree with me. The fact is that people have very different views on what ails the Singapore market and, consequently, on what the MAS Review Group's priorities ought to be. Some people tell me that many of the smaller cap companies listed in the Singapore market suffer from weak fundamentals and a lack of attention to corporate governance. The way they see it, these companies would already have attracted the attention of global fund managers if they were any good. So injecting $5 billion into the market through the EQDP is only likely to have a fleeting positive effect on the market. Well, here's what I think they're missing. Companies can and often do take measures to improve their fundamentals, especially when they're incentivized or pushed to do so. In episode 53 of this podcast series, which was recorded back in March, just as the STI had breached new all-time highs for the first time in nearly 18 years, I noted that the robust gains charted by the index since the end of 2023 had really been driven by a very narrow group of companies, which had strong core businesses and were actively unlocking value. Among them were the three banks, DBS, OCBC, and UOB, which had benefited from a few years of very elevated profitability as interest rates rose, and that had been actively returning substantial amounts of excess capital to their shareholders through increased dividends or share buybacks. Also among this narrow group of gainers was Hong Kong Land and Singtel, both of which had sprung to life as the pandemic waned as a result of systematically strengthening and growing their businesses and actively unlocking value. Other gainers included SATS and ST Engineering, which had made bold strategic investments to enhance their business profiles as the pandemic eased. The key to restoring the vibrancy of the Singapore market is for more companies to similarly reposition themselves and prioritize shareholder value. Fund managers under the EQDP should, in my view, use their influence as shareholders to ensure this happens at the companies in which they're invested. This could be easier said than done, of course. Getting companies to make fundamental changes to their businesses and offload non-performing assets could mean running up against the vested interests of their boards and controlling shareholders. What can be done to encourage companies to prioritize shareholder value? Can more be done to give minority shareholders more clout? I'm going to talk about that next.
Breaking news from the Business Times podcast team.
Hi guys, this is Emily Liu, your host of Market Focus Daily. I've got some great news. Come July, Market Focus is getting bigger. I'll be bringing in market and investment experts into the studio to share analysis and opinions on what moved the markets and what to look out for in the week ahead. Every Friday, starting on July 4th.
Look out for Market Focus Weekly from the Business Times or wherever you get your podcasts.
And now, back to Market, a podcast of BT correspondents.
When the MAS Review Group unveiled its first set of measures in February, which included the $5 billion EQDP, it also provided a laundry list of measures it was still studying. These included getting companies to sharpen their focus on shareholder value and shareholder engagement, and better enabling investors to seek recourse and recompense for losses due to market misconduct. The review group also said it's looking into a possible shake-up of the Catalyst board, the modernization of the central depository's post-trade custody infrastructure, and even adjustments to the board lot size. It seemed the MAS review group was prepared to examine and address every gripe and grievance that might be holding the Singapore market back. It now seems that some of these measures are being developed and may eventually be implemented. Last month, when MAS announced the first batch of fund managers under its EQDP, it also outlined its plans to better enable investors to seek recourse if they suffer losses due to market misconduct. Specifically, MAS said it will consult on proposals to enable investors to ride on a court action or civil penalty in order to seek compensation. MAS will also consult on proposals to allow for representatives, such as the Securities Investors Association Singapore, or SIAS, to organize and carry out legal action on behalf of investors. In addition, MAS will consult on setting up a grant scheme to defray the costs of organizing investors and taking legal action for cases involving market misconduct. Now, the purpose of these proposals is to reduce the so-called friction investors may face in taking civil action against companies. And if this results in companies and their boards becoming more cautious and more mindful of the interests of minority shareholders, then I think the proposals could be useful. However, I'm not sure investors should expect that these civil actions will make them whole after they suffer losses. In the high-profile case of Noble Group, for instance, the authorities only commenced investigations in late 2018, more than 3 years after Iceberg Research began sounding the alarm about the company's financial statements. By the time MAS imposed a civil penalty in 2022, which, by the way, amounted to only $12.6 million, most of Noble Group's value had already been lost. Unless regulators can act more quickly when trouble emerges, investors may have little to gain by trying to ride along with them. In fact, investors may be better off quickly selling their shares when they see some catastrophe beginning to unfold, instead of holding on in the hope of eventually being able to seek recourse. As for representatives taking legal action on behalf of investors, the big question is, who would these representatives be? Chieh seems to be the most obvious candidate, and MAS specifically mentioned that organization in its statement last month. In response, Chieh said that it stands ready to act if appointed to assist with any litigation, but it also reiterated its long-held position that it is better to engage with companies in the boardroom rather than a courtroom. The way I see it, Chieh should not be pushed to take on a role that does not align with its own philosophy. Representatives who take legal action on behalf of investors should be completely comfortable in a courtroom. And if there isn't an organization already in existence that can safely take on that role, perhaps MAS should just create one and provide it with the necessary funding to build its expertise and capability to carry out its purpose. My own view is that most investors would ordinarily not want to engage with a company in a courtroom or even the boardroom. That usually only happens when something has gone terribly wrong. Most investors don't want to have to fight with a company's board and management. They would much rather be invested in companies that are already doing the right things and acting on sensible feedback from the market. The appropriate forum for investors to engage with listed companies on most matters, in my view, is neither the boardroom nor the courtroom, but the public square. While better enabling investors to seek recourse when companies stumble is a positive move, I'm looking forward to MAS developing specific proposals on getting companies to sharpen their focus on shareholder value and shareholder engagement. The way I see it, the EQDP will continue to spur liquidity in the local market in the months ahead. In the end, however, that liquidity will flow towards opportunity. Pushing companies to focus on shareholder value and being more accessible and accountable to investors could now be the most important aspect of forging lasting vibrancy in the Singapore market. In fact, if the STI continues rising and bullish sentiment broadens out further, companies could well find themselves under pressure from investors rather than regulators to find ways to unlock value and achieve sustainably higher levels of profitability and growth. Listed companies in Singapore should now proactively review their business strategies and their approach to engaging public investors. Companies that communicate their strategies effectively and deliver results are likely to be rewarded with market-leading stock valuations, while the ones that don't will not only be left behind, but will probably also no longer be able to blame chronically low stock valuations in the Singapore market. That's it for this edition of Mark to Market. BT Correspondents will be back next week with wealth editor Genevieve Kwak, so please keep listening. If you have any thoughts or questions about the show, email us at btpodcasts@sph.com.sg. I'm benpaul. As always, thank you for listening and join us again next week.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.